Good afternoon, everybody. This is Wes Cleckley with Interlink Mortgage coming to you from Garden Ridge, Texas. Thank you all for joining. And I have Corinne with me. You can't see her. I was trying to get her to pop in. There she is. So she's going to help monitor our chat. So I just wanted this to be an informative webinar. The title is, Will Housing Remain Hot? I've got some slides. I'll be sharing my screen here soon. But if you watched, probably most of you that are on here have watched the videos and short updates I've done through the Facebook Lives that we normally do. And I've touched on a lot of this stuff, but it hasn't been a very in-depth explanation with slides and all that. So I wanted to go in depth on it. So thank you also for joining. I do want to open it up for questions because it's going to be a lot of material. Some of it will seem a little foreign to you. So please ask questions. We'll answer a lot of them at the end, but we'll also do our best throughout the slides here. If you've got a question in particular to that slide, we want to try to answer it the best we can. So yes.
Ask everyone to put hi in questions when it's working.
Corinne asked if you could all put hi
or something
in the comments there so we'll know that that's working. So please do that for me real quick.
Hi. Thank you, Jordan. Okay, there you are. We're good.
All right. All right. So I'm going to go ahead and share my screen. All right, Corinne. Can you see that?
I can't see that.
All
Go
right.
ahead and
I want it moved over here.
no.
No.
Leave it there. And then it goes off the screen.
Okay. All right. So I'll do my best to look at the camera and look at the slides here. So again, title, Will Housing Remain Hot? Because what is all the chatter about? What's been going on in the real estate market? I mean, I assume a lot of you are realtors, but some of you may just be home buyers, some of our past clients. All this information we're going to talk about today is really relevant to everybody that either owns a house or wants to own a house. So that's really the entire population, right? So we're going to talk about interest rates, which is a big question lately because they've been all over the map. We're going to talk about low inventory, which has been the dominant conversation in real estate lately. And if you're a real estate agent or if you're a home buyer, you know how tough it is to go under contract. So we're going to talk about all that. We're going to talk about broader economic forces that are impacting this stuff, like inflation, the money that the government is spending, new Janet Yellen. I mean, all kinds of stuff, right? So anyway, I get asked all the time, what's going to happen? What are we going to be in a housing bubble? All right, so we're going to go through that in detail because everybody, if you've been around long enough or you bought real estate prior to 2006, 2007, 2008, you all know what happened in that housing crash because it didn't just impact the housing industry, which it impacted it majorly, nationwide, but it impacted. I mean, it was the Great Recession, right? I mean, it took us a while to come back out of that, but we had so many forces at that point. I mean, one of it was the crazy loan products that were out there that exacerbated the problem. I mean, I went through it. I got in the mortgage business in 2002, and I was a mortgage broker from 2004 to 2008. So I was a mortgage broker right in the heart of all of this crazy stuff. 2004, 2005, 2006 was like one of the most epic times ever to be in this business. But anybody that was breathing pretty much could get a loan. And that was a problem. Those products should not have been offered in the extent that they were. Some of the products were there for a reason. You had some self-employed people that had good credit and had a little bit of a down payment, but they just couldn't really prove their income. Maybe they had a ton of gross receipts. They got bad advice from the CPA, I don't know, but didn't have a great bottom line. So in that case, there should have been some products, and I think should be some products, more products today that allowed them to do a more asset-based more financing instead of being able to prove the income on the tax returns. But back then you could have a 600 score. Imagine that, a 600 score, sometimes even 580, when right now today, if somebody, we can go down to a 580 credit score in FHA, and FHA alone pretty much. VA, we can get down there pretty close as well, but we have to vet everything. We have to verify income, assets, everything on the credit report. But back then, you could have a 600 score, get a 80-20 loan. So a first lien of 80%, second lien of 20%, not prove income, not prove assets, and buy a house. So that just really exacerbated the problem and caused a housing crash, a housing bubble, a housing crash. And that's what everybody's scared of today. I mean, hear it all the time. You probably witnessed it if you're a real estate agent or a builder on this call. Like, hey, I have some buyers that are been thinking about buying, but now they're getting cold feet because they see that appreciation nationwide, appreciation nationwide went up 10% last year. So if a house it was worth 300,000 at the beginning of 2020, it was 330,000 on average at the end of 2020. I mean, that's a massive, massive jump. Now we didn't have quite 10% here in Texas. I didn't pull it up, Karina. It's probably in the 5 or 6% range of appreciation, but that's still a lot. That's still a lot. When in the past, you could probably bank on a 2 to 3% appreciation amount. So a lot of people right now are saying, I think I'm just going to wait. I have buyers all the time that say, well, I know I'm pre-approved and I really want to buy while rates are low, but I'm really waiting for these prices to come back down. Well, I tell them all, and I go through detail on that conversation and usually change their mind that prices aren't going anywhere soon. Prices are going to continue to go up, and it is a simple fact of supply and demand. If there is a great demand for a product, toilet paper, cartons of milk, whatever, I mean, the price will go up, right? Same thing with housing. So let's get into some charts. All right, so Janet Yellen, she's back. And what is she known for? She loves to spend money. All right, so she's the new Treasury Secretary with a new administration. And she gets to sign all the money, actually. So she'll be signing the new $100 bill. So I'll go back to that. You can see she'll be signing right there. All right, here, let me move my mouse there. You can't see my finger, that's kind of crazy. All right, there you go, mouse right there. She'll be signing all the $100 notes, but she loves to spend money. She loves stimulus money from the government, right? She's a fan of spending and very different from the former Treasury Secretary, Steve Mnuchin, all right? When you have somebody like that, it's believed the currency would be debased, and then gold and silver and even Bitcoin has gone up tremendously because they know that the dollar could devalue because of all the spending. All right, so that's what we're facing with her. And it also results in inflation. All right, so we talk a lot on these videos about inflation because what's driving up interest rates right now? It's actual reading of inflation and the fear of further inflation. As a matter of fact, so rates, if you watch my videos, rates have gone up anywhere from 0.5 to 0.75%, depending on what day you're on, from the Friday before the snowstorm. I think that was February 12th, was the Friday before the snowstorm. Rates were fantastic, right? And let me just say this real quick before we get too far into this. Rates are still fantastic. So if you're thinking about buying, or you have some buyers that are thinking about buying, but they say, well, we're going to hold off because interest rates are phenomenal. They're still in the 3s. I can still get in the 2s depending on the type of product, how many years and all that. But rates are awesome. Rates were 2%. Almost 5% in 2018 and in January 2019. We were locking rates. We're refinancing a lot of those folks right now that the market was 4.75 or close to 5%. So the fact that we're still in the 3s, even low 3s, almost 2% lower, rates are still great. So those buyers that are out there thinking they're going to wait and let rates come back down, we'll get into the rate discussion here in a second, kind of the trajectory we think they're going, okay, based off all these market forces. So inflation, though, here, let me get to the next slide. Well, let me talk first about the Fed funds rate, because I get asked this all the time. Hey, the Fed just lowered the rate to 0, and you can see on this chart. Okay, Fed funds rate got up to about 2.25 or so, and then the former Fed chairman, the Fed actually lowered it down. You can see it dropped right here and then dropped drastically down to 0 at the beginning of 2020. All right, so what were they trying to do? They were trying to spur on the economy because we went into a little bit of a recession, believe it or not, in February of 2020. So even before COVID hit, recession was starting to happen. So the Fed saw this happening. So if you see a recession, which, obviously GDP is go down, two consecutive quarters of GDP decrease, that's a recession. They saw that coming. So what did they do? They wanted to lower interest rates to spur economic activity. So that's when they lowered interest rates to zero. All right. So I got all these questions at the beginning of 2020. Hey, Fed rates are zero. I want to buy a mortgage at 0%, or, buy a house at 0% rate. Well, it doesn't have an immediate impact. You do see here, this is the 30-year fixed rate right here. It did trend down. But I want to tell you, look back in, I think this is, I can't see the bottom of this, but 2009, 2016 or so, you can also see the Fed funds rate was zero. So what is the Fed funds rate? It is short-term interest rates. It's the rate that the Fed sets for banks to borrow money overnight from each other. So they can borrow money overnight and it's 0%, right? So the Fed controls that rate. So they bring that rate down anytime they want to lower the cost of borrowing money. If the cost of borrowing money is low, then people can borrow money for businesses, for all types of ventures, vehicles, and all that. That increases economic activity, can bring you out of a recession. But as you can see, at this time period that we had a 0% Fed funds rate, you can see the mortgage rates were all over the map. I mean, look, here's 5% right here. You go across, rates dipped down around, mid fours, went up to 5, went down, went back up close to 5. So you can see that mortgage rates were still very volatile, irrespective of what the Fed funds rate is. And I wanted to have a slide on that and just show you some graphs because we talk about it all the time. The Fed funds rate does not immediately impact 30-year mortgage interest rates, okay? All right, let's get to the next slide. Let me go back one more thing on the interest rates though. So the Fed funds rate doesn't impact mortgage rates immediately, but one thing you can watch if you want to know the trajectory of mortgage rates, one, obviously call me or watch our videos weekly because we'll give you a pulse on where that is. But if you ever want to watch the chart, it's the 10-year US Treasury. Mortgage rates follow the path almost to the T of a 10-year US Treasury. So what has happened in the last few weeks? The 10-year Treasury went up. It shot up to, I think it broke the ceiling resistance of 1.37. At the lowest point last year, during all the COVID craziness, it got down to 0.5%. So a 0.5% yield on a 10-year Treasury, lowest it's ever been. Well, what's happened here lately, it shot up past the 1.37, and then it shot up all the way to 1.61. And then today, well, I had to pull up another screen, but we are trading back up there. So rates have gone up 0.5 to 0.75%. We've gained a lot of ground back on Friday. So what determines rates is these mortgage-backed securities that are sold and traded on Wall Street. Okay, so they sell in basis points. So from the February 12th, good price on the bond, we lost at one point 300 basis points. I believe it was Wednesday or Thursday of last week. 300 basis points in the bond market. I know you probably don't understand that, but the simple fact is 100 basis points equates to about 0.25% in rate. So if you lose 300 basis points in the bond market, mortgage bond market, you lose 0.75% in interest rate. Well, the interest rate increases. So if somebody had a 2.75, now they qualify for a 3.5. On Friday last week, we gained 117 basis points back. So they actually improved by 0.25%. So if somebody was getting 3.5, they actually at that point could get 3.25. So you can see how volatile it's been. We gained a little bit of ground a little bit yesterday, Tuesday and Monday. And then today, the Fed Chairman Jerome Powell got out and spoke. The whole market pays attention to Jerome Powell. And he came out and talked today about inflation. He addressed inflation and said, yes, inflation is increasing, is expected to increase a little bit, but he didn't say that they were going to change their monetary policy at all to try to stop inflation. The markets didn't like it. The stock market didn't like it. Last I looked, the Dow was down 600 and something points. Then I think it got back to like 450 or so. But interest rates are going back up today. Last I looked, we were almost 50 basis points down in the bond price, which is about 1/8% increase in rate. All that to say is you're going to hear a lot of chatter day in and day out during the next few weeks or however long this will last about the volatility. So I know, and put this in perspective, if you were yourself or a buyer, or you are a real estate agent or a builder that has a buyer and they want to shop around for the lowest rate out there on the market. Well, I'm going to talk to all these lenders. I'm going to jump on Lending Tree and I'm going to just get the very best rate on the market. And they get inundated by 10 to 15 different lenders all at once that are online lenders that have no other business model but to advertise online and advertise the lowest rate. By the time they shop around for the lowest rate, maybe finding 1/8% better than what we quoted them, they may have lost 1/4% in rate in a matter of hours, right? So that's just kind of a perspective about how volatile it's been. Again, 1/2 to 3/4% higher than we were prior to the snowstorm, but we're still at a great spot. All right. I want to go, it's kind of shift gears a little bit. So if you're looking at this slide, as debt increases, interest rates decline. So most people don't know that. Usually when debt increases, the government's spending money, it makes interest rates go up. And here's why. So if the government is spending money and to produce economic activity, so the economic activity and the production of or the spending of new money actually creates inflation. Inflation is the arch enemy of interest rates, and it increases interest rates. So think about it this way. Say if you're a bank and you lend somebody money at a certain rate and you get a rate of return on that at say $2,000 a month. All right. And then inflation happens, but you've got this fixed rate of return of $2,000 a month after month after month. You take that 2,000, you can go buy, say you're a household, you can go buy goods with it. You can go buy food, you can go buy household goods or whatever. You've got a list every single month you've got to buy, and you've got $2,000 to spend. Well, if inflation is increasing, the value of that dollar is less. So that $2,000 is actually buying less each month. So you get some items on that list that you can no longer buy anymore. Right now, that happens slowly over time, but as a lender, you can't do anything about that loan that you're fixed at $2,000 a month, but all the loans moving forward, you're going to try to make up for that higher rate of inflation, and you're going to increase the rate that you start at. So just remember that increased inflation increases interest rates. It just is basically it's a law in finance, right? It just happens. So as money is being spent, as the economy, so what's happening right now? Why is inflation heating up? Well, the economy's opening back up. Great news on COVID. By the way, if you didn't see the video yesterday, great news on COVID. J&J, Johnson & Johnson, had produced the third approved vaccine. The FDA approved it a week or two ago. It's a single shot vaccine. It didn't show, the efficacy rate didn't show as high as Pfizer or Moderna. However, it's a one shot, and you also don't have to have it in like sub-zero temperatures to ship. So it's easily transported, and they were projecting to have 100 million vaccines available by the end of the year. What happened this week was great news. Merck was also working on a vaccine, and they did not get to produce their vaccine. They either failed or didn't get to produce it in time. So even though they're like arch enemies with Johnson & Johnson, they actually came together to do a good thing. Merck decided to partner with them, use 2 of their facilities to produce the Johnson & Johnson vaccine. So it's increasing Johnson & Johnson's vaccine from 100 million to a projected 200 million doses by year end. So that's all good, positive news. In fact, the government just came out a few days ago, said that we should have enough vaccines to vaccinate every adult in America by May. So I think that's phenomenal. I mean, the fact that they got that many vaccines produced in that amount of time, when they said it would take 5, 6, 7 years to do it, and now we're going to be able to have everybody vaccinated by the end of May. I mean, that's just an insane feat, and it's such great news. And you got all kind of positive stuff happening. With that being said, everything's opening up. Economy is roaring back. Economic activity increases inflation. Inflation increases rates. So that's why rates are bumping up a little bit. Also, the fear of inflation, as I mentioned. So the government's trying to pass $1.9 trillion in more stimulus funds. And this is not to try to get political or anything, but only 9% is going for COVID, right? So I think it's money that shouldn't be spent. It's going to cause more problems than it's helping. If this passes, it's going to be almost $6 trillion spent since COVID's happening for stimulus, right? If the economy's coming back, I don't think we need to spend $1.9 trillion, because here's what's going to happen. 1.9 trillion people, it's just, they're pumping money into the economy. So it's going to be good at first, right? Stock market's been loving it. Stock market's at record highs and the economy's rebounding, but it's going to cause more inflation. So interest rates here short term could go up a little bit more, but it's not expected for them to, and that's what this slide brings us to, not expected to last long. And it actually they could pull back a little bit. So the sky's not falling on rates. We still have a long ways to go where we were back in 2018, 2019. But short term, they're going to increase because of inflation, but could pull back a little bit. And here's why. As debt increases over time, interest rates decline. Now I said over time. So initially it's going to have that initial pop. When you put all that stimulus money, all that debt into the market, you have that initial high, all that economic activity, but then you've got the debt service later on, which means less money being put into the economy. So it's like a hangover, right? So interest rates will eventually decline. And that's just a fact here. Look at this chart. If you go back, you can see the dates here. So back in 1959, debt started really, well, that's where it crossed the this blue line here. So once it started going down, interest rates started going up, and you had this peak. You always hear about the 80s. If you're in real estate, or if you bought a house back in the 80s, you know, the interest rates got all the way, mortgage rates, some people were paying 14, 15, somebody even told me they paid 17 or 18%. But look how low the debt was at that point, right? Debt starts going back up, interest rates start coming back down, and then look here. Look what happened around 2008. You know, again, well, I won't get political on that. Debt started shooting up, right? Debt started shooting up, rates came down. And then look what happened this past year. All that stimulus for COVID, all that stuff needed to happen. The PPP loans and all that kind of stuff, we needed COVID relief, but it increased debt. It shot up, right? Look what it did to rates. So as debt increases, interest rates decline. That's why we think, and a lot of the sources I get this information from, Barry Habib that has MBS Highway that we look at every single day to get this commentary on the whole market and actual rates. He believes that rates will go down over time with all this money they're pumping in there. So I think that's a positive thing. It may not be good. They're also talking about, hey, there could be a slight recession in 2022. Because after all this spending, all this big economic expansion, well, then where's the rest of the money coming from, right? So we could see a little bit of pullback. Again, I don't think, of course, it's in a whole nother slide here in a minute. Housing, which is the title of these slides, will housing remain hot? We do believe it will. This is just another slide just to show you in other countries. This says it's a thing. As debt increases, interest rates decline. So you can see right here, France, debt increased, interest rates decline. Japan, debt increases, interest rates decline. With Italy and the UK as well. Okay, so that's why I think with the record debt that we have, interest rates should remain low. Okay, now will they be at 3.25? Will they be at 3.75? Will they be at 4? We don't know. But will they be at 5, 6, 7%? Probably not. Not with everything that's happening. All right, so again, rates will remain low, but so inflation is going to be pressured low because of the debt. We just talked about that, but also technology. All the technology and automation and efficiency that happens out there actually keeps inflation tame. The labor force is still down 10 million people. Okay, why do I bring that up? So at COVID, all the jobs that we lost, the labor force is still down about 10 million people. So what happened? Those 10 million people aren't working. So what did that do? That interrupted supply chains for goods. So the inflation that we're actually experiencing right now is on the goods side of things. So goods, commodities, things like that have actually increased. And that's been the main increase of inflation, which has driven interest rates up. Okay, so supply chain disruptions. Again, I used this the other day in a video, but when the storm hit, people couldn't deliver goods, right? There was run on supply. What would you have paid for a gallon of milk? You probably, if you really needed milk, you probably would have paid $50 a gallon for milk if you really needed it, but you couldn't get milk anywhere. There's a supply chain disruption. Trucks couldn't get there, icy roads, all that kind of stuff. So when you have supply chain disruptions in goods and manufacturing, costs go up. All right. So this slide is talking about right here, talking about keeping inflation low. So inflation, I think, will tame down once all these people, the rest of the country opens back up and the rest of these 10 million people get back to work to alleviate the supply chain disruptions. That will even out prices or more normalized prices on the good side of things, okay? Additional spending under new administration will increase supply of treasuries to be sold. That's going to keep inflation down. And again, we just covered that, but rates are likely to bump up a little bit higher. We just experienced it. They could bump a little bit higher before hitting that downward trend again. All right. Okay. Corinne, we right on target?
Mm-hmm.
Just making a face at me over here. I don't know. Do we
2:30.
2:30? All right.
Good.
All right. Good deal.
Perfect time.
Again, if y'all have any questions on any specific slides or anything that I say, maybe something I said didn't make any sense, it's very possible. Shoot a comment in there. We'd love to interact with you. And again, we can answer many questions at the end. So let's talk about the housing itself, the low inventory. So this is where we're gonna talk about. So we talked about rates. Now we're gonna talk about the inventory, because rates are important, but that is not really the problem. The biggest headline, in my opinion, right now, the biggest headline, in my opinion, is what you guys are all experiencing right now, is there's just no houses out there to buy. Every single contract, it seems, has multiple offers, right? We're going to talk about some ways, remind me to talk about some ways to alleviate those offer challenges in a minute when it comes to mortgage and the terms and everything you put on the contract. But people keep asking, I think I started off with that, is this going to be a bubble back in 2007, 2008? Well, the difference is back in 2007, and I think it's probably on a slide up here, isn't it?
Yeah.
Here, let me see. I'm going to skip ahead a little bit. All right, I'm skip ahead. I want to just show you this slide. In 2007, we had a peak in inventory. This is nationwide stats, okay? But 3.7 million houses on the ground back in 2007. Again, this is right before the bubble, the big burst. Again, there was a lot of things that caused the housing crash. We talked about the loans and all that stuff, but we also had an oversupply of houses. Builders were just going gangbusters. 3.7 million units on the market. Compared to today, this is actually a little higher than it actually is right now today. It's actually just a little over 1 million units available nationwide on the market. Okay, so you got almost a quarter of the inventory than we had back in 2007 in the peak, right before the housing crash, the housing bubble. So let me go back. All right. Here's the other thing. You have way more first-time home buyers today than you did back at the housing crash. Okay, so you had almost 4 times the amount of houses on the ground in 2007. And why am I focused on this? Because I hear every single day, oh, we're going to be in another bubble. These prices have just increased so much. Everybody's going to wait and let them come back down. It's not going to happen. They're not going to come down for several years, maybe not even flatten out for several years. So I tell you that so you have the ammo, you have the information, if you're a realtor, to go out and tell your buyers that, or if you're a buyer, I want you to understand this. If you've been thinking about buying that bigger house, that second home for the first time, or some investment properties, don't think that you can wait for 12 months and buy them cheaper. It's just not going to happen. Supply and demand. If you got way more demand than you have supply, right? So, I mean, the prices will continue to go up. And I'm going to show you why I don't think that's going to happen for several years. What I mean by not happening is flattening out or lowering. All right, so look at this. The median birth rate for the first-time home buyer is 33 years old, okay? And why am I focusing on first-time home buyers? Because they're the ones that impact the inventory or the lack thereof on the market today. So if I own a house and I'm selling my house and I'm buying another one, that is an even exchange. That's a net zero effect on the housing supply. I put one on the market and took one off the market. No change, right? No change in the amount of available houses. But if I'm a first-time home buyer, I'm renting an apartment, I'm living with mom, whatever it is, I go buy a house for the first time. I just took a inventory. I took 1 unit of inventory off the market. So first time home buyers is what's really impacting the already low supply that we have right now. And it's just making the problem even worse. And I think it's going to remain this way for a long time. So 35% is going to get to 35, 36, 37, 38% of your home buyers out there are going to be first time home buyers. And it's going to increase each year. And here's why. So if the median age of the first time home buyer is 33 years old, okay, if you go back 33 years from 2021, you get to 1988, right here. 1988, 1988, 1989. This is a chart, births underlying each generation. This is US birth chart, and you can look this stuff up. So you had an explosion of births. I don't know why. Maybe, I think that was the Reagan years. I guess times were good. But you had an explosion of the birth rate, 88, 89, and 90. So you see it increased each year. You had a lot of births here, more births here, more births here, and then it finally went down a little bit in 1991. Okay, so what does that mean? Go back 33 years, that's 1988. 1989, that'd be 2022. 1990, that'd be 2023. There's expected to be more first home buyers in 2022 and in 2023 than there are today. Right? I mean, you compare that with a low inventory and the almost 4 times as much inventory in 2007. But what happened in 2007? There was a lot less first time home buyers. So you subtract 33 years from 1977, and that's 19, hold on. I should just be able to do simple math here, but that would be 1973. Okay, where did I write that down? This is not a political statement either. It's simply a fact. What happened in 1973? This is 1972. Here's 1973. January 1973, Roe v. Wade was passed. And look at it. This is actual birth charts from the US numbers here. 73, 74, 75, 76. Look at this. A major dip in births in the US. Add 33 years to all those years right there, you get into the 2006, 2007, 2008 timeframe when you had 4 times the inventory on the market, but a lot less first-time home buyers. So you can just see with those 2 factors right there, why we're in such an inventory crash or inventory shortage. Here's another thing that exacerbated the problem. COVID slows down new construction. Look at this. These are housing starts. I can't read that. Can't read that. Yeah, housing starts, okay? So here's housing starts. Here's the units over here. And you can see it. I mean, it ebbs and flows each year. But look at this. We had an explosion of housing starts prior to the pandemic. And then what happened? Just plummeted. Okay? Now it's coming back up as they started opening back up after those crazy 3 months. I mean, even here in Texas, I mean, we had 2 or 3 months where everything was just completely shut down. But
6 months.
6 months?
Mm-hmm.
What's 6 months?
The dip is 6 months.
Oh, the dip is 6 months. So I had this big dip right here, Chris, just pointing out, again, my eyes aren't that good. I should put my glasses on. But it's a 6-month period. But look, low inventory already, more first-time home buyers, and then construction just got shut down. So all these things are reasons that the housing shortage is why it is right now. And also, I mean, we already knew this, but what happened after people were shut down a little bit? You had a lot of first-time home buyers that would have remained renters, but they're like, you know what? I'm tired of this COVID mess. I'm ready to get out of the city. And they've said, you know what? I would love to paint my house. I'd love to remodel that kitchen. I'd love to plant some plants in the backyard, but I don't own this property. I finally, for the first time, want to be a first-time home buyer. So that hurt the problem. That hurt things even more. People are moving out of the city to the suburbs to the country. You know, I have so many conversations on a daily basis. Hey, I want to buy a few acres. I know you guys are too. But anyway, all that to say, we're in inventory shortage. I should have bought a whole bunch of houses a few years ago. All right, here's another thing that so prices, home prices are being pushed up and supported by low inventory, but also low vacancy support prices. All right, obviously a low vacancy rate right now. I mean, people can't find houses, they're renting. right? And how many people are moving to Texas? You got Californians, people from Washington, all over the U.S. moving to Texas. So it's, I mean, gosh, we could probably list about 100 things of why the inventory is so low. So on vacancies, if the vacancy rate is high and you're an investor, you own some properties, you're going to end up taking less for that rent, right? If there was no vacancy, I mean, if there was no vacancies at all. So if it's hard to rent your place, you're going to take a lower rent than what you could otherwise. Lower rents will also bring those prices of those investment properties down, right? Overall. Also, if you didn't have a vacancy, or if you had vacancies, you have higher carrying costs, you may decide to sell your house as opposed to carrying that carrying cost, and you might sell it at a lower price. So that would also push prices down. But low vacancies is what's going on right now. So that is also helping home prices stay up. So that's something I didn't really think about until I watched this slide and learned something. All right, what do we got here? All right, we're already talking about the record low inventory. So kind of getting to one of my last slides here. So all in all, is it the housing market going to remain hot? I 100% think it's going to remain hot for years to come, despite what the stock market does. I mean, we're plummeting right now. We'll come back tomorrow. Despite all the other factors, housing will remain hot, and I think interest rates will remain relatively low. Yes, could we spike up to 3.75? I'll say spike up like that's just super high, but I mean, today we're in the low threes. All right, could we get up to the high threes? Could we get to 4.5? It's possible, but it's really not going to impact the demand for housing because people need housing no matter what. And people start talking about, I didn't include this slide in here because I didn't think we'd have enough time to do it, but I'm just going to touch on it real quick. People talk about affordability. So it depends on what news station you watch. They'll try to put fear out there. I guess they get good ratings for it, but they talk about, oh, home prices have just gone up so much. Housing is getting unaffordable. It's just not true. We're in the 7th most affordable period than there ever has been to buy houses, right? And yes, home prices nationwide have gone up average of 10%. Here, maybe 5 or 6%. But weekly earnings have increased tremendously also for the broader U.S., right? And just really think about it. If you're earning more on a weekly basis, you're not using all of your earnings to pay for that mortgage anyway. It's just a small percentage. So as earnings increase, yes, home prices are increasing, which are increasing the payment a little bit. We're actually more affordable now than we were last year, right? So it's just not true about it being unaffordable. I mean, rates would have to go up a lot for it to start really impacting that. And I don't think that the Fed's not going to really allow that to happen anyway. Because there's a lot more the Fed can do. So if you've heard of quantitative easing, that's what actually is happening right now. What that simply means is the Fed purchases billions of dollars of treasuries and mortgage-backed securities on the open market. So as more of these assets, these securities hit the market, bonds and U.S. treasuries, if nobody's buying them, then the price goes low. So there's no demand for them. The price lowers of those bonds. The yield has to increase. What the yield is the rate. So if somebody's buying those bonds or buying those U.S. treasuries, in this case, the government is taking up all the extra. They're artificially keeping long-term rates low, right? And they've announced that they're going to do 40 billion a month. They're actually buying about 100 billion a month right now because they're trying to keep low. They know that if interest rates go up, it will kill the economy. So they're just not going to let it get too crazy. So that's another major factor on why I don't think interest rates are going to go too high, because they know we're trying to overcome. I mean, we're obviously way better here in Texas than the rest of the country as far as being shut down and all that. Abbott's reopening the state 100% next week, which I think is great. Has nothing to do with the mask, but if you're going to finally allow events and venues and everything else to open up at 100%, it's helping these small business owners, right? Let them finally make the money that they need to make to pay their mortgage and bills. Right, but we're in way better position than the rest of the country. Look at California, look at New York, those people are hurting, right? So the government knows this, everybody's suffering. They're not gonna let interest rates increase too much because they know that it'll kill the recovery and kill the economy. All right, so again, all great positive news. Rates will stay relatively low. Stay tuned to our updates because it will change weekly. And I'll be doing these quicker. I'll try to do about a 5 to 6 minute update on a weekly basis, just gonna give you a snapshot of the rates. inflation, stock market, and things like that, housing inventory. But I think we're in a great position. If you're in this industry, it's one of the best times to be in it. If you can have the patience, I know you're having to show a lot more houses than you probably normally show if you're a real estate agent. If you're a home buyer, you're having to see a lot more houses. You're having to put in multiple offers. So quick, how much time we have? We got some time. Just quick, a few tips. If you are yourself buying a house, or if you're an agent that has a buyer, one, get them with me. Get them with me soon. Before you start showing them houses, most people won't even allow a showing, much less an offer, but even allow a showing unless you can prove that they are pre-approved. So don't work with them for a few weeks. Don't show them any houses. Get them with me early. Tell them that you have a lender that you know and trust, that's local, that's going to be accountable to you and accountable to them, that you can come in and stand on his desk if you're not hearing from him, but it's not going to happen here. Let me call them. Let me make them comfortable with this process. Let me give them a bit of this information. Let them know right now is a great time to buy, because they're not going to be, they don't want to be a renter forever. And if they wait a year, wait 2 years or 3 years, I can run some charts for them and show them the cost of waiting and what that will be. I think it's a great time to buy. I want to buy right now. I want to buy additional properties because I just think it's the best investment out there. All right. So if you have somebody, let me get them pre-approved. And then when you're going to make an offer, there's several things you can do. One, you can do a shorter closing. So if you know it's going to be a multiple offer situation, you've talked to the listing agent and they've told you, hey, there's 2 other offers. Hey, we got one that's going to close in this amount of days. Maybe they don't tell you all that, but maybe you find out that they're going to be a 35-day or 40-day closing. What if you came in with a 25-day closing? Do you unshare? Okay, great. She unshared my slide. Thank you.
You're welcome.
All right. Can you see me now?
Yes.
Good. All right. So what if you came in with a shorter closing? What if you were told by the listing agent, look, we might consider your offer, but the seller really needs to be out of this house in 22 days or 21 days. Call me. It's very possible, depending on where it's at, because we have the appraisal factor there, it is very possible we could get it done in 21 days or 22 days or 25 days, right? Not all loans take 30 days or more. If it's on the outskirts of town, outskirts of San Antonio, it will take longer for the appraisal, but we have things we do to try to mitigate that. If you get us a contract, we're going to close to the buyer immediately, our loan disclosures. We're going to order that appraisal day one, unless you tell me not to, unless you tell me there's an issue with the inspection. Maybe there's a foundation issue or a roofing issue or some kind of structural problem or some kind of problem that just may kill the deal. But I can go ahead and order that appraisal. And if you tell me a day later or 2 days later that, hey, we're going to back out, no problem, I'll cancel the appraisal. If they cancel the contract on day 10 of the option period, and I've ordered the appraisal and the appraisal is in, I'm not going to charge your buyer. I'll pay for the cost of the appraisal. I would rather just get out the gate early and get everything done so we can close faster. So there's a lot of things we do on our end to allow us to close quick that could possibly help you win that deal. And what if you also shorten the financing contingency? So there's multiple things you can do on that offer to make your offer and your buyer more attractive. So a lot of folks just do a 21-day financing contingency, but what if you did a 15? In fact, what if you didn't do a financing contingency at all? You may think, wow, that's risky. But what does a financing contingency do? It says you got 21 days to secure your loan approval. And most people look at that as, well, that's the underwriting approval. What we do here as a loan officer, myself and my whole team, our job is to make sure we look at everything and make sure before you have that letter, we want that letter to be looked at just as good as cash. But when you get that letter, we want you to know that everything's been vetted out. That's just as good as a underwriting approval. All right. So maybe you don't put any financing contingency on there. Have me call. I'll tell the listing agent, listen, I've met with the buyer. I've looked at their assets, their credit. I've run it through the automated system. Everything is golden on this buyer. It will close on time. You know, so there's so many things you can do. Maybe you have the buyer pay for the title policy if they have the funds. But anyway, there's a lot of things you can do. If you have a buyer that you need some help on and you need to try to win that offer, give me a call and we can try to strategize on it. All right. Corinne, do we have any questions at all on anything?
Yeah, no, nothing.
Do we have anybody still watching?
Yeah, they're all still
Good.
here.
All right. We got a few minutes, folks. I kind of ran that. I thought it may take an hour, but got finished a little bit early. So if you have any questions on any topic at all, it can be just mortgage related, it could be housing related, interest rates, anything, please shoot your comments in. I'd be glad to answer them. We'll give you all a few minutes here. If not, contact me personally. email me, call here at the office. I'm here at the office, 210-569-0401. And if you got any comments, if you want to shoot some comments or email me and say, hey, I would love to hear about this or maybe less about that, I'm all open. Just let us know.
Jordan Walker says y'all are great and that she appreciates the update.
Jordan, thanks for jumping on.
And Tiffany Kimball said thank you too.
Thank you, Tiffany. Appreciate that. And again, if you guys, you probably saw the video, but if you don't like our Facebook page, Cleckley Mortgage Team on Facebook, please like it because you'll get the notifications as soon as we do an update. And we have them scheduled Wednesday at 1 o'clock. But if some breaking news comes out, just like we did before when the rates were really going haywire, we'll jump on there real quick and just give you a quick update. And of course, if you don't catch it live, you can always go in there and look at it, or you can call me. You guys all have my contact information. If you don't have it, we'll get it to you.
Okay.
What?
So Vanetta asks, she goes, so I have buyers that missed out due to a cash offer. You've already proved them, but what kind of closing terms should I offer for the client? It may have made a difference in this case. Different closing terms.
Yeah, Vanetta, I would get with me on that specific buyer because here's what matters. This applies to all of you that have buyers out there. It's a big deal to know, to communicate with me, or if you have a buyer that's working with another lender, it's a big deal to communicate to the loan officer or myself what kind of cash position the buyer is in. Because it's very different. I mean, there's a lot of buyers out there that don't have a ton of money, right? That don't have the 3.5% if they're doing an FHA loan, plus the $6,000 to $7,000 closing cost. I mean, look at it. If you got a $200,000 purchase price, that's $7,000 down payment, and another $6,000 or $7,000. So you got a total of $13,000 or $14,000 cash that they have to come up with. So I know in these lower loan amounts, especially, or lower purchase prices, it's very difficult, if not impossible, to get the seller to pay closing costs. So we have to know that first. You have to know what you can go in there at, right? Maybe we can qualify them on our 100% financing product, right? Or if you know they have enough cash, go in a little bit higher. I mean, that's the one thing that people always think about. Hey, we'll just go in higher on the price. Well, you can do that. And if it doesn't appraise, then they would have to bring the difference or negotiate at that point. But you could always go in a few thousand higher. If it appraises, great. They just got to put their 3.5% or 5%, whatever program they're doing, on that purchase price. But I would do a shorter term. So when you're about to make your offer for this buyer on the next property, call me. Let's go through that specific house. Let's pull up the taxes on it. Let's see exactly what the property taxes are. I'll calculate almost to a T what the total closing cost should be. The only thing we don't know yet is the homeowner's insurance, but we get a pretty good estimate on that. But we'll be able to talk to you and the buyer on that exact house on what the numbers look like. It's possible maybe they got some more flexibility in their interest rate, or their monthly payment. So what I mean by that is, if say they qualify for a 3.25, but maybe instead of 3.25, we were able to give them a 3.5% rate. It didn't affect their payment by a whole lot, maybe 30 or 40 bucks, depending on what the price of it is. But that 3.5 as opposed to 3.25 allowed me to pay for some of their closing costs. So that could bridge a shortfall they may have in cash that the seller's not going to pay for either. So that's an idea. But I would call me on that. Let's go through that specific scenario, because one, you could increase the price. Two, we could do a very short closing date. We have to know where it's at. I mean, if it's in Seguin or Canyon Lake or something like that, the appraisal is going to be a little bit longer. Three, shorten the financing contingency, or don't do a financing contingency at all. Right? That may scare you a little bit, but why is the financing contingency there? So you got the 10-day option period typically, and they can back out for whatever reason up to 10 days, lose their option money, usually $100. Then they have 21 days to secure their financing. If they don't get financed, or they don't get approved within 21 days, then they get their earnest money back. I've always thought that was crazy anyway. And I guess that's in there because you've got a lot of incompetent lenders. And I'm not trying to be ugly about it. I'm just saying, why do we have to have a financing contingency up to 21 days? I mean, if I'm a seller, I'm not going to like that at all. What do you mean we got a financing contingency? Don't you already have them approved? Why would we have 21 days to be able to decide whether they are approved for a loan or not? Doesn't make any sense to me. So I would say, don't do a financing contingency at all if it's going to win that offer. Because if I'm a seller and I'm looking at comparable offers and there's no financing contingency in there, I'm probably going to take that one. And like, here's the deal I'll tell you. It may scare you. Well, what if their earnest money, what if they don't get their earnest money back? I'll tell you what, if I screwed up on it, and I'm not going to, but if I screwed up and I said they're approved and then I say they're not approved on something that I messed up on, not the fact that the guy lost the job or something, I'll refund their earnest money. It's just not going to happen, right? I've already approved them. So unless they lose their job or something drastically changes that's out of my control, I mean, I don't really see why you have to have 21 days if that's going to win the offer. Okay, then maybe you can even shorten the option period or something like that. I mean, I've heard of people going in with no option period at all. But that's a choice that that's a decision we need to make. Let's talk about it. Let's talk about it with your buyer. But if it means them having no option period, no financing contingency, offering over the price, and allows them to become a homeowner as opposed to continue to rent and pay somebody else's increased rents year over year, that might be an option that'd be worth going after. That's just my opinion.
She said she will call you and that she appreciates it.
You're welcome. Anybody else?
No, nobody else.
All right. Well, thank you guys so much for jumping on. I know it's a lot of your time out of the day. Hopefully the information was valuable. And again, please get feedback. We're always open to feedback. Just like if I'm working, Vanetta, I'm working on that client with you. Thank you so much for referring them to us. But if there's ever a time that you feel like, hey, there's something lacking in the communication we've had with you, or your buyer says something, we want to improve our process and our service to you and your client every single day. So let us know how we can help or do something better or different. And that goes for these videos as well, these webinars. Let us know, give us some feedback, because we want to make sure we're bringing you the best and most relevant information to you and your profession. All right. Well, y'all enjoy the rest of this beautiful sunny day and weather, and I hope y'all have a good weekend. Call me if you need me. Take care. Bye-bye.